Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. So thankful to have you join us here for the July 25th version of the Market Carver. We've got a couple of topics for you this week. We're going to hit investing in politics, a dangerous combination there, but have some context that we hope you'll find very useful in how to think about and navigate the couple of months that are ahead of us. And then take a look at investor expectations from a survey that we saw put out here recently. And we'll dive actually right into that. Investor expectations. We'll look at the United States, start there, but it's actually a global phenomenon. And if you look at the data here, it's really interesting. The blue line you'll see are individual investors' expectations of the long-term real return. And when we say real return, that means the total return minus inflation, and that is a whopping 15.6%. So really on the heels of what has been really a great 15-year or so run after the great financial crisis. So we have had a good 15-year run, but doing what investors typically do, which is extrapolate the near-term future. There's a very rosy forecast, and that's not a bearish point that we make. It's just there's a lot of people out there that I think would need to throttle back. Certainly, if that's what they need to reach their retirement goals, could be destined for some disappointment there. The black bar are the average of the financial professionals' expectation of 7%, which is spot on to the historical average. So no surprises there, but just always have to keep expectations in check. Certainly 15.7% is possible. We'd take it. We'd love it. But it's a little bit wildly unrealistic given history, and it's very difficult to continue that. So just some interesting thing. There's one other sidebar that I don't have a chart for here, but we did talk about in our Monday allocation is a breakdown by demographics and how young people are investing versus old people. Just found it really interesting that the younger generation, those that are in their 20s and 30s, have a very hefty allocation to alternatives. Which is something that we've talked a lot about over the past 5 years. But what was interesting to me, when we say alternatives, for us, that usually means real estate or perhaps private credit or private equity. Your tried and true alternatives. Too often these mean tennis shoes and other collectibles as a big piece of the investment portfolio for so much of the young generation that has even higher return expectations than the 15% you see here for the U.S. So just an interesting caveat. And another segment would be, I guess, cautious about having that sort of return over a long period of time. So those are expectations. I'll pass it to Andrew to really give us some great context for how to think about the political landscape.
Yeah, thank you, Adam. So this is a topic that we discuss every few weeks in our allocation meeting. While we don't, and this is the main point I want to drive home, while we don't make decisions based off of who's in the White House, who's in Congress, off the latest presidential debate, or any of the headlines that are taking over the news, especially right now, as I'm sure you all are, just like we are, getting a little tired of hearing so much about politics. It's the time of year that we're in, every 4 years we have to do that. But with the upcoming election, we do get a lot of questions about it. How does the politics, who wins, who loses, how does that play into the stock market? And so we've talked about this a little bit earlier in the year. We want to bring it up again as we get closer to election day. And so the first chart we want to share is looking since 1900, looking at the Dow, and this is looking at the Dow Jones Industrial Average, the real version, real performance, meaning it's inflation adjusted. So that's why you'll see the numbers on the sides may not line up with where the Dow is now. This is looking at inflation adjusted. And you can see if there's red, it's when there was a Republican in the White House, blue was a Democrat in the White House. And the market has gone up and down during both types of administration. During the boom years of the 20s, we had a Republican in office, same as when we had then the Great Depression in the 30s. During the tech boom, the roaring 90s when everyone was going gangbusters in the stock market, we had a Democrat in office, and then we shifted to Republican, back and forth. But you can see there's money was made during both types of administration. Where people got in trouble was when they tried to make a differentiation between only investing when their political party was involved. And that's where the next chart that I think was a really big favorite of our advisors, and we think it's really impactful, and we wanted to share it with you today, is if you just had the mindset of saying, I only want to invest when a certain political party is in office, the detriment that can have historically to a portfolio. And this chart looks, again, now looking at just investing since 1961 through 2023. If we only were putting money in the market during Republican administration, $10,000 would grow to a little over 100,000. That same 10,000, if we only invested during a Democrat administration, would grow to about 500,000. But then look at that far right bar. If we just stayed invested and we didn't take into account politics, that 10,000 would have grown to just over $5 million. Now, of course, there's lots of caveats, taxes, transaction fees, spreads, all the different disclosures we need to put up with this. But what the main take-home point is, and this is why we're so adamant about not taking such a political view towards the market, is that the market is separate. Similar to when we say the market's separate from the economy, the market's separate from who occupies the White House. And we think there's so many more beneficial tools and data sources we can use to properly manage risk, to properly seek out returns, than basing things off a Republican or Democrat being in the White House. So while we do think it's important, we don't minimize the significance of who our world leaders are, who actually is in the White House. As far as an investment view, we think there is much better ways to manage money, and we can see that it's actually been leaving a lot on the table when you try to let political views take over an investment portfolio. So we thought that was pretty interesting. We hope you do too. And of course, we'll always be updating our views and thoughts as we get closer to November. But the underlying theme will always be we're focused on the market. And I think that's probably where you would prefer our eyes to be anyway. So thank you.
Yeah, absolutely. And so well put. It's one of those things. It's just something we've said so many times over time, and it is easier said than done. So the more that we could show you real data, and that's where our eyes are on the ball. So as always, we thank you for joining us, giving us your time. Here's a reminder to give us a call if we can be of service at all, 800-928-4001. We'd love to hear from you, or scan the QR code and book a meeting electronically. So thanks again. Have a great weekend.